Welcome everyone to the June edition of the Shaw & Partners monthly video update. Look, I must admit, I do keep waiting for a relatively quiet, uneventful month, but so far, if there's one thing that 2026 has delivered, it's a never-ending flurry of activity. We've now had 3 months of disruption in the movement of freight through the Strait of Hormuz, and duration of this conflict was always going to be the determinant of the potential impact, and it is lasting quite a bit longer than initially expected. But before we talk about that in more detail, let's have a look at how markets have fared over May. And the tech-led rally continued, bringing with it increasing market concentration in both index composition and return attribution. So the global share market index, it lifted 5.3% in US dollar terms, helped by a 10% lift in emerging markets. Now that's a very healthy month. But look, the dispersion between sectors can clearly be seen in the US market index returns. The Dow Jones up 2.9%, pretty strong, but well under the S&P 500 return at 5.3% and dwarfed by the 10.6% lift in the Nasdaq index. European markets delivered positive returns, but more in keeping with that Dow Jones result rather than the knockout Nasdaq performance. Now, the Nikkei was also a very strong performer in Japan there, rallying almost 12% in the month alone. Now, those returns are in local currency terms. The New Zealand dollar strengthened over the month, so New Zealand dollar returns were lower. But that momentum that we reported in April continued right through May, and it was another pretty special month for most share markets. Look, and in another repeat of the April theme, Australasian markets underperformed. The ASX 200 in Australia was up 1.1%, the NZX 50 beat that at 2.7%. But look, in summary, we saw a continuation of that sharp risk-on rebound, reversing the geopolitically driven sell-off seen in March, and also the market adopting a pretty sanguine approach to the Middle East situation. Okay, so the Middle East. Well, look, it's drifted into a stalemate of sorts. Negotiations are continuing, but the Strait of Hormuz is still effectively closed, which means that around the world, strategic oil reserves are being drawn down and extra production is being employed where it can be done. But over the month, we did see expectations of a negotiated settlement rise, and this saw the oil price react, falling from over $110 a barrel for Brent crude at the beginning of the month to $92 by the time the month closed out. And that sort of certainly helped buoy investor sentiment, adding to the very strong tailwind that was already there from the strong US first quarter earnings season. Now, we can't talk about the month of May without mentioning the continuation of the spectacular rebound that has been seen in specific sectors. So we've got an index of semiconductor stocks. It's called the Philadelphia Stock Exchange Semiconductor Index, or SOX. Now, it displays this remarkably well. It hit a low just before the end of March, and then in the most incredible fashion went on a wild, unfettered 95% gain over April and May. Look, in early June, it did reverse a bit, but a 12% fall only took back a very small part of that massive lift. All in all, investors should have seen further pleasing gains in share market exposures in their portfolios, particularly in the global share funds. So let's have a look at interest rates. Well, it was a game of two halves, really, over the course of the month. Longer rates, or longer term rates, lifted in the first half of the month, and then they fell back again. But US interest rates generally continue to drift higher, and the resilience of the US economy is really shifting expectations for what happens next with US policy rates. That's the Fed fund rates. And markets are now pricing in a hike to the Fed funds rate by the end of the year. But look, as ever, we continue to manage investment portfolios with a longer-term view. Look, we note these short-term movements, but we keep our focus on achieving consistent returns over the medium to long term. Now, look, the Middle East situation, look, it's increased uncertainty generally, and we've seen higher levels of volatility in things like the oil price, but we need to always consider it together with key market drivers, the fundamental drivers, growth, inflation, the trajectory of earnings. But at a high level, the US economy looks quite resilient, and in early June, US non-farm payrolls suggested the employment market is pretty robust. Another short-term factor to consider is the impending public listings of some massive companies, SpaceX, OpenAI, and Anthropic. They've all either announced or are expected to announce their intention to go public this year. Now, they are very large companies, and the process of listing and then potential inclusion in market indexes will have short-term trading impacts. Now, looking at the local market, a key development over May was the Reserve Bank of New Zealand indicating that the official cash rate would need to rise in their cash rate review, and that's due to the deteriorating trend in inflation. CPI inflation is now expected to lift over 4% in the second quarter of this year, and that is well outside of the target range of 1 to 3%. The thing is, though, financial markets were actually already pricing this in. They expected that. Domestic growth, though, is also expected to slow. So what that will do is deliver an unpleasant combination of high inflation and weak growth. But both the central bank and New Zealand Treasury do expect inflation to fall quite quickly after that and growth to rebound. And if I look at data from May, when we saw petrol prices coming off their highs, it suggests that things like consumer confidence could recover quickly if the price of petrol at the pump falls. Now, we are continuing to hold our current strategic asset allocation position, but we're sort of mindful of the mix of our global fund managers, and we're staying attentive to potential areas of overvaluation. In times like this, a well-diversified approach to portfolio construction is required, with that attentive monitoring and a preparedness to react once we believe an outcome is more certain. But with the degree of current uncertainty, seeking guidance in how to participate in financial markets is a prudent move, keeping your investment portfolio consistent with your long-term investment objectives and risk tolerances. So look, if you need help or guidance, why don't you get in touch with us, and we can help you navigate financial markets and, importantly, retain a focus on the long-term perspective, and we will bring our decades of experience to the table to assist you in providing for your financial future. But if you do want to know a little more, you can look us up on shoreandpartners.co.nz or on Facebook and LinkedIn. We'd love to hear from you.